What's up, everyone? This is a special episode of Portfolio Talks. It is not our regular scheduled programming, but when certain things happen, like SpaceX going public and all the talk around the IPO, was it good? Is it bad? Is it hype? Is it not? I think it's always worthwhile to jump on and do a special episode. So today we're going to be talking about SpaceX, the largest IPO in history of a company going from private to public. And what does that mean? Is it a good investment? Is it a bad investment? What you shouldn't be doing is should I buy SpaceX or not in a vacuum? It should be part of my larger investment picture or not. And a lot of you may already have that position without even knowing it because you're an ETF investor. So we'll chat about all that fun stuff in the special episode of Portfolio Talks, SpaceX IPO.
Hey, getting money is my job. Come and pull up to Portfolio Talks. Hey, paper stacking round the clock. Time to pull up to Portfolio Talks. Yeah. Portfolio Talks. Hey, Portfolio Talks.
What's going on, everyone? We are chatting about SpaceX today. So SpaceX IPO was the largest in history. It's a company that everyone's heard about for a long, long time, but it was kind of like this mysterious thing that no one really knew was going public until it came close to the finish line. Luckily, a lot of you watching this will probably already be our clients realistically that are in our private portfolios that had pre-IPO access to things like SpaceX and other ones that are coming down the pipeline. So you got the advantage of SpaceX earlier on, and then the big bump that came with it going public, and all the fun stuff that comes with that type of access into high net worth private wealth investments and sophistication that you get with it. So you probably already heard a lot of these conversations already, but we wanted to take this time to discuss the IPO of SpaceX, to discuss what it looks like, what is the investment, and what's coming down the pipeline. So this episode will be very, very heavy on the Tyson side because Tyson is our expert when it comes to investments. So he'll be chatting and letting us know about pretty much everything investment and SpaceX IPO related and all that kind of fun stuff. So hope you enjoyed this episode. This is actually going to be launched on our podcast as well. And some of you are already watching on the podcast. So let's jump right into it. So SpaceX IPO, what's going on? What's been happening? What's the news?
Yeah. Let's make one small correction. I hate the term, the label investment expert. I've only met a few experts and they are awesome, but they're hard to find. Investment nerd, I'm okay with that. I do love to nerd out on this stuff.
Yeah, we're all nerds in our own right. So yeah, our investment nerd, Jason.
I know. Expert's a tall order to live up to. So it was super exciting. And we did talk about this with our existing clients on our platform prior to it going public in the IPO. So we knew about it a little bit in advance. And there was a lot of tech nerd rumors for the last year of what was happening. And then finally SpaceX filed their S1. We kind of had an idea of what they were doing. So it was only 5% of the shares that were really being pushed out there. They're trying to raise about $85 billion in capital, which they accomplished. They valued themselves in the S1 at about $1.75 trillion. And on opening day, it pushed well above the $2 trillion mark. And private shareholders were very, very well rewarded. So how does this avoid hype? And what is this actually doing? So if we rewind to the beginning of the story, private wealth partners had access to SpaceX when it was a $40 billion valuation. So this was years and years ago. This entered into our funds about 5 or 6 years ago, and it was at that time a $40 billion valuation. Very, very small book cost for us to invest. We did not put a ton of money into it. But a ton of money was made on the way out. And, when we're looking at IPO day, it was about a 50x on the investment, which is awesome for long-term growth investors, which is always the theme that we want to come back to. Is we didn't buy a trade on the day, is this was a tree that was planted years ago, and we're now just seeing the fruits of it. But what does all this stuff mean? Having access to the types of investments that we have, it's very much following the endowment model. It's a certain amount of publicly traded equities, which is stocks on the stock markets around the world, whether it's Canadian, US, or global equities. But then it's also private equity, private credit, private infrastructure, private strategies that really are not available to to like regular everyday investors are available through platforms like this because they build it out essentially like a pension fund. And so this fund, through our partners at Kinstead Wealth, they had been an early investor in one of these funds that had SpaceX, and it performed awesome. I won't say the numbers, but it was a very, very small single digit, $1 million investment turned into well over $100 million of profits for the client, and great for client portfolios. And even just like on the day, the IPO date, like double digit returns for our clients. So many of them that have come on even in the last year have seen awesome performance. And it's not that we want to say you're going to get this performance every month, but it is cool to have those events. So what happens like kind of going forward? There's going to be some capital distributions, right? There's going to be return of capital, and there's also going to be distributions of capital gains out to investors. So you're going to see some flows and stuff starting to happen. There will be some tax slips generated for some people if it's inside a registered account like an RRSP, a TFSA, an RESP. You won't get tax slips for those. But you will see the bump in your portfolios, which is really good. Because the sizing of the position has grown so much, they will have to trim the position a little bit in order to maintain a balance in the portfolio. You don't want to be overweight in any one company, even if it is a super cool nerd company. So over the next 6 to 18 months, we're going to see them trim that position down to something that's more reasonable in terms of an allocation. So it's just rebalancing. I think before I go into anything else, Phil, did I miss anything so far?
No, I think it's a good story to share. Like, I think it was like 2020 is when that initial investment happened, and is just a part of the overall portfolio. So I've never been a big fan of throwing all your eggs into one basket. Like, this is a sure thing. This is a sure thing. It wasn't a sure thing. It was just something I was like, oh, okay, cool. Like, you invest in the founders and all that kind of fun stuff. And what they expect this story is like plans to acquire this, and then acquire this, and then acquire this. So you understand the story and the trajectory of it. So you make it a small part of an allocation. And if it hits, fantastic. If it doesn't hit, it's not the end of the world. So I think that is a good thing to go back to, where it's part of responsible investing, not just hoping for the hype to hit and that makes or breaks you. So I just think understanding that was bought. I think it was like 2020. I'm pretty sure is when that $40 billion valuation came into, and then 2026 now. So it's one of those things that's a slow moving investment, and a lot of it is relationship based, because I know a lot of our clients had that question of how do we get access to pre-IPO stuff, and when it comes to a lot of these private wealth shops, a lot of it is just access based on relationships. Like, who do these people know? What kind of access they get into? Because they're not going to buy these companies directly. They have partners. So the same as we have partners that handle that private wealth, they have partners that handle very specific findings inside their portfolio. So it's very relationship based. And I know that's a question we get asked all the time, is like, how does this even happen? A lot of it's relationship based, and it's not a sure thing. Hence why they don't throw all their eggs into that basket and try and hit an absolute home run. So it's still responsible investing. Just want to circle back to that point, but that's it. I'll defer back to your nerdness.
Yeah, right. And I think it does give us an opportunity to kind of zoom out, just like kind of along the lines of what you were saying, is like this is private equity investing, but like, what is private equity and what does that mean? So a lot of our clients, and we talk to our students about this too. You're going to be a doctor, you're going to graduate, you're going to have lots of money. The first thing that's going to happen is family members are going to come to you and be like, hey, you should invest in my business. You could be a private equity owner. And their business is, whatever, a hot dog stand, an apartment building, a restaurant that's going out of business. Like they get pitched all kinds of opportunities. That is private equity. What we're talking about is institutional grade private equity. Ownership in like the airport in Sydney, Australia. It's infrastructure. It's there. It's not going away. If you're going to fly into country, you got to go there. It's going to get used. Bridges, toll roads, AI infrastructure, sports teams, very, very institutional look at things that are not going to go away. And long term, they're gonna make money. That was the one we talked about last year, which the sports franchises. Having the sports fund in there, it's a very, very small allocation, but the story is really, really cool. NFL, NBA, NHL, MLB, F1 racing, Major League Soccer teams, very, very wide ranging revenue streams per franchise. And you get partial ownership and all that, it is another cool, like, nerdy event. But we're looking at the private side that is very institutional level. We're following a model that CPP now follows, now uses, and Canada Pension Plan Investment Board is one of the top, like, 5 investment shops in the world. They're recognized for what they do, and we're not copying them, but we're using a very similar DNA to the process that is being built, so that clients have access to top quality institutional grade investing. This is not investing in one building that we know the address to, that you can drive by the building. This is investing in things where, it's known around the world. They're stable. They are going to produce, and they're going to do very well long term in the portfolio. Okay, so that's our boring part that we should cover. We have to cover as part of the education piece, but. Like, what's next? What's in the pipeline? Some of the other things that have been invested in the funds they filed. They could IPO at any time. The next big one is Anthropic. So if you've ever used Claude AI versus ChatGPT, Anthropic is going to IPO maybe at the end of this year, maybe early next year. But Claude has been a major growth factor in the AI provider space, and picking up into like enterprise contracts, doing things that other platforms aren't necessarily doing yet, which makes them a leader, makes them one of the best ones. I really enjoy using it. I've tried a couple of different ones. The CIO of Kinsted Wealth is very bullish, very optimistic on this. The investment is not as big, I think, as what it was in terms of SpaceX, but the multiple on the IPO day could be the same or more. So this could be another really, really good, impactful piece for the portfolio. One's expected for 2027, Databricks. So that's all AI infrastructure is behind the scenes. They're a platform company, and similar in the veins of SpaceX and Anthropic, maybe not on the same scale. We might not see the same exit, but it'll be really good. And then the other one is OpenAI, which is ChatGPT. It's also in the funds. It's also filed its S1. It could IPO at any time. And the thought at the beginning of the year was SpaceX, OpenAI, Anthropic would all be racing to get to the IPO first, because the market can only take so much. And so we're trying to see who's going to go first. And, I think nobody wants to be third. So those are some of the big names. DataStripe is also in the portfolio. They're rumored to IPO. So it really is the year of the IPO, the resurgence of IPO. And throughout that COVID period of time, we did see a shrinking and even a stoppage of IPOs. Nobody wanted to go to market and take their companies public. They stayed private longer. And I think we're going to see a flip on that, where a lot of these companies are now ready to go into the public market space. There's reasons for that. But if we're holding it for the long term in the portfolios, then we get rewarded when they do go public.
Yeah. That's it's a wicked thing to see what's coming down the pipeline. And as we think about our day-to-day lives, the thing I like the most about these are companies that we use on the day-to-day. So it's things that we understand, things that are inflation-proof, recession-proof, and are growing. And that's why we always like about private investments is a lot of the larger revenue-driving companies stay private because they have more control. There's not so much like governance and disclosure you have to abide by being a public company, so you can make decisions and scale to a certain point until you get too big where you need a large amount of capital investment. Hence, you go public and start to the next level. But I love the fact that a lot of these companies are private that we use on day to day. You may not realize how much you use it. Like Databricks, I don't think people realize how much they actually use Databricks. Anthropic for sure people know. OpenAI for sure people know, and they're growing ever so quickly. So wicked stuff. So it comes down to like I think the growth is a good part of it. When it comes to like the rebalancing or the exiting, like what does that look like? So I think it's a question a lot of people have. Okay, cool. Like we had a huge entry and growth in the public markets, but how do we exit, and what's the plan to get our money back? Are we able to, like, do these companies have to hold for a certain amount of time? Like what does that all look like?
Yeah, there's always requirements on how and when you can sell. So SpaceX did like something interesting is they had like a chart of how and when you can sell, and so we're not really involved in the dictating of that. We're invested through a fund that invested in SpaceX through the private equity side, and so we'll have our turn eventually to liquidate some of those liquidate some of those shares and trim our position. There's going to be several events that happen between now and the end of the year. So, like for instance, we're taping this on Wednesday, the 24th. On Friday, it'll be 2 weeks from the SpaceX IPO, and then they will be officially listed on the NASDAQ. So we'll start to have indexes, index funds, and ETFs across the spectrum that are forced to buy, which is really interesting. It's new. I used to have to wait 15 months, I believe, and now it's 15 days. And so we're going to have forced buyers of these shares, and it'll be really nice for valuations for us who are exiting. We're not trying to buy the public shares of this company. And that is essentially what's going to happen with all of these private holdings is when they IPO, we get the opportunity to liquidate our private shares at publicly listed pricing. And we don't control when that happens. The funds do that stuff, but we get to reap the benefits of the rewards and being long-term investors.
Yeah, awesome. Another thing I would add on to that, and Tyson, if you were to clarify it a bit more if you can, but when it comes to the tax treatment of it, a lot of the times it'll come back on these private ones, is you'll get return of your capital first. So if you invested, I don't know, let's say $100,000 into it, you'll get your $100,000 back first, which will not trigger tax because that's your own money back. And then you'll start to receive the capital gains portion of what it grew inside of that investment. So that's again the sophistication that comes with private wealth and being able to control and have a little more flexibility on the taxation of your investments. So depending like where you hold that money, if it's privately, corporately, or whatever, you have a lot more flexibility. So I don't know if that's a SpaceX thing or is that just like the private wealth? Like that would be probably the same story with Anthropic and OpenAI.
Yeah, I think unfortunately the phrase "it depends" applies to this. Is how the individual funds that we're in, how they choose to do it. And so I think with this case of SpaceX, because the tilt is so much to the growth side, is they're actually trimming capital gains first so that the fund maintains a position that's reasonable. You don't want to be so overweight in any one company, even if it's the coolest company that you could think of. Like even if it was like a position in Google. Everybody uses Google. I'm on Chrome. I use Google stuff. But you don't want to have a tilt in your portfolio that's above a certain percentage point. Then it would be irresponsible from a diversification standpoint. And so they're going to start trimming capital gains down. Clients are going to start seeing distributions of capital gains, and they will also see return of capital at some point, and then it'll be reinvested into the strategies as they rebalance the funds.
That makes sense because you don't have too much deferred tax there that's sitting there and that can swing left or right. So that makes sense. Awesome. Anything else that's coming on the pipeline that we should know when it comes to SpaceX or any of the private investments? Anything that's new and exciting down the road?
Yeah, I think there's some other things that are exciting that we get to talk about. And so like one of the great things about our partners that we choose to work with is access. Access to the CIOs, access to the portfolio managers, and really getting to talk to them and pick their brain. So, this episode is about SpaceX. SpaceX is held in our Kinstead Wealth Partnership portfolios. And I got to talk to Brent Smith, who's the CIO, the Chief Investment Officer. And he had a bunch of other things to say just about like what's brewing, what's in the background, what he's excited about. He is an investment nerd. And so I get to talk to him as a nerd, and he loves it. It's great. So one of the exciting opportunities is the private equity side, because it's not listed on an index that you can just look up and see and track and gain access to things. It is truly a relationship business. And so Brent has been in the industry a long, long time. He has relationships in many different areas, many different countries, different companies. When you're investing and you start building partnerships and pipelines to some of these deals and some of the funds that come up, after you've invested or built your partnerships with these different companies, you get the opportunity to do something that's called co-investing. Co-investing is something that's done outside of the traditional fund profile, where like if we're buying a fund from BlackRock or Blackstone or KKR or Hamilton Lane or any of these like big private equity companies, after you've established a deal, sometimes you're offered the opportunity to co-invest directly in some of these companies, which means it's outside of the framework of a fund, which means it's less fees for clients. It's direct investing, and it means it's direct returns too. So you're not getting returns that are sort of eroded by fees on the exit. Great opportunities. So it's like getting a little bit of rocket fuel into the investments, into the companies that we already believe in, and you're just going to get like a little edge on your returns. So co-investing is something that he's talked about a couple of times when I've talked about him, and the opportunities that are there are really exciting. And it just comes from working in the space, building relationships, and having access. So being able to invest, in some of these companies that the valuations, the future looks really, really good. And adding a small allocation, then, and he talks about funds that are adding billions of dollars in some of these like co-investing private allocations. And we're talking in like millions of dollars, responsible allocations in the portfolio, but you do get to co-invest and you do get that little bit of rocket fuel there. So access is based on relationships. It's based on being around. It's based on our track record of what we've done, but it is a really nice entry into some of these other things that's good for the portfolios.
Love it. So I think we talked heavily on like the equity side, like the SpaceX, the Anthropics, the Databricks, all those like software tech companies. But is any new additions? I know there's some that are been talked about, but any other new additions to the pools or investments that aren't tech related that have high upside?
Yeah. I mean, like the boring stuff is also there. It's always present. And I think you really need that to ground the portfolio, because the initial messaging that we want to use is really good diversification. You want a portfolio that's going to stand in all weather conditions, whether the market's going like this or the market's going like this. I mean, can we take advantage of those situations? And also, the number one rule is don't lose money. So we want to make sure we have the right portfolio. So we talked, when I've talked to Brent about this stuff, he's really excited about some of the infrastructure funds that we've got access to that are in the portfolio. Infrastructure technically is boring. It's an asset class that's based on stability. And, you're talking about like water and highways and airports and things that are like hospitals, things that are there that we need as a society, but maybe we don't always think about. But he's got some funds in there and they're targeting 19% rate of return. And they have a historical track record of doing that, which he said, for infrastructure that's boring, it's not really supposed to do that. But some of the funds that we have access to are doing that. And so we're adding pieces of that to the infrastructure side, which really bolsters like that good, solid baseline. The other thing that's in there that we talk about is kind of cool, but it's the royalty funds. So you buy partial ownership in these things that produce royalties. So the one that we make fun of all the time is like in November, December, you're going to go walk into a store. It's Christmas time. They're playing Mariah Carey on repeat. Well, there's a royalty that's paid every time that song gets played. And we own part of that royalty catalog. So Mariah Carey's in there, Taylor Swift, Shawn Mendes, The Game. There's a whole bunch of other music artists that are in part of the music royalty catalog. And maybe we'll leave a link to the music playlist that's on Spotify in here. So you can kind of see like the diversity that's in there, but it is kind of cool. But then there's also medical royalties, medical patent royalties. There's a few other ones that were in there. And so these are income streams for the portfolio that are not correlated to market conditions, interest rates, other things. It's if they get used, you have to pay to use them. And there's a royalty that comes from that. And it goes directly to the owners, which the fund is a part owner in the catalog, which is really cool.
Yeah, and I think that's perfect. We wanted to keep this episode short-ish, just to kind of talk about SpaceX and talk about private wealth and all that kind of stuff, because historical numbers are that the IPOs do pullbacks over the first year, and that's the reality of it. And it's not a thing that we want to say chase the pop or chase the vibes, chase the hype, and that stuff. A lot of the people that made money when access was very limited. So if you were starting to invest in SpaceX, for the most part, when it goes public or right before it goes public, you're probably not going to be making too much money for a while, but it's a good long-term hold because it's a real company. It'll grow. But if you're expecting a short-term pop where it's going to be like how GameStop was for a bit, and then it totally pulled back. That's kind of the story that you see for the most part, not just for SpaceX, but for all these IPO companies that went huge, especially during COVID. That time, right before that, everyone was racing to go public for that reason. However, if you were pre-IPO, there was a ton of money to be made in pre-IPO, and that's kind of the historical thing that we usually see is the early investors that get in prior to it being close to public and then going public and then jumping on the ETFs and index funds. Those are the ones that tend to make a lot of money. It's really about a diversified portfolio. So there's tech, but there's also farms. There's Anthropic, but there's also music royalties. There's this, but there's also sports funds. So it's really about a diversification globally, diversification for industries, and just making sure that we don't lose money and your money is growing in real things that are inflation recession proof, and they just keep on turning profits, which is the beauty of the private industry. Um, so if you have a question how this can be part of your portfolio or anything like that, just reach out to your advisors or reach out to us, and just we can chat about it. But if you are a wealthier client, that you're over a certain level, that you're like thinking, maybe I shouldn't be invested the same way that my niece or nephew's investing with their first $25 a month on a pack payment, and you want to be like, hey, what's out there? This is stuff that's out there, and that was the purpose of this episode, to really share the story of SpaceX, but share how you can add it to your portfolio, so the next SpaceX you're taking the benefits of that as well, and it makes sense from your overall financial plan and the taxation perspective. So, anything to add before we jump out of here, Tyson?
No, I don't think so. I think we covered the things that we wanted to. I'll be doing my investment chat with the chief investment officers of the companies that we deal with in July. So after the mid-year numbers come out. If you guys have questions, if you want something addressed, if you want to ask, leave a comment below. We will reach out. I'll make sure that's added to my list of questions when I talk to them about what's happened, December 31st to June 30th. And what do we see for the next half of the year? Those are the kind of things that we want to know. Not that we can necessarily see around the corner, but what's already kind of baked in that we're excited about.
Love it. Awesome. Hope you guys have a great day and enjoy this special episode on Portfolio Talks about SpaceX and the IPO world. So chat soon.